Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. US futures edge higher after Wall Street takes a breather from the AI-driven rally. Investors, though, weigh the possibility of a bubble in the sector. Bloomberg learns Intel has approached Apple about a potential investment in the struggling chipmaker after locking in funding from Nvidia and the US government. Plus, Washington sets the stage for levies on European robotics and medical devices. This as Beijing seeks to cool trade tensions, urging Chinese companies to avoid taking price wars to the US.
2 down days for the S&P, Anna. Will today be a third? Doesn't look like it from the futures picture. Futures, though, pointing lower ever so slightly here in Europe. Copper nearer year high, just below it now. But this is because of the disruption out of Indonesia. You've seen stocks in London knocked for the miners yesterday. Does that continue today? And euro dollar at a 117 handle right now. The countdown to the opening trade starts right now.
Thursday the 25th, good morning, folks. What is happening in the stock market? One of the key questions that we need to try and answer right now. Bubble, no bubble, what is happening? Remember, Powell on Tuesday, Jay Powell, the chair of the Federal Reserve, said this, quote, that stocks are fairly highly valued. Is that a foreshadowing of something deeper and darker to come for the stock market? Well, certainly that would not be the emphasis that a lot of other people are placing on this market. You've got Bank of America out overnight talking about the fact that we are in a new normal. This is not a bubble. And that actually, if you dig beneath the surface, good things are happening and it will continue.
Yes, absolutely. So I predict this will not be the last time that we ask whether we are in a bubble, but we ask it this morning because, as you say, Bank of America, amongst others, have been talking about it, the Fed too. What Bank of America is doing is looking at the S&P market cap against GDP and saying that, sure, yes, things look expensive, but this is a new normal, as you said, Guy, and therefore we don't expect mean reversion. Now, does that sound a little bit like it's different this time?
Yeah.
And to what degree do structural changes mean it's right to say it is different this time versus that being a fool's errand? Because we've been there before. Many times people have declared things to be different and they have not been.
So they're saying it is different this time. It isn't the dot-com bubble. Let's look at some of the news that's coming out in tech at the moment. Tech stocks in China up again. You've had the Alibaba news
up
already.
Again.
And now you've got the likes of JD.com and Huahong up on all of this enthusiasm about the AI spending. You've got more news on tech funding from around the world. You've got Intel asking Apple for funding. We knew that Intel had the pitchman in Donald Trump, Nvidia pouring money in. We asked who's next. Now we've got Apple potentially to be the one. What does Tim Cook want in return?
To please Donald Trump, maybe, is what he wants in return. Maybe is the answer to that question. The quote that really stands out to me is stock prices have reached what looks like a permanently high plateau. So that was Irving Fisher. He was a Yale professor. That was October 1929.
OK, excellent. That doesn't bode well. I'll see your quote and raise you another one. Former Merrill Lynch analyst Bob Farrell, this quoted by Edward Harrison in the Everything Risk column. Exponential, rapidly rising or falling markets usually go further than you think.
Yep.
That makes sense. But they do not correct by going sideways. So we just remember that. But it doesn't matter if you're just on the upswing. We talked about this yesterday.
That can last for a long time.
If we're in 97 and not 2000, 2001, then, you know...
Yeah, what people were telling us yesterday is it's your job to handle a bubble.
Yeah, you've got to manage it. We're in the bubble. We're in the early phases. Potentially, we don't know where we are. But the job of asset managers now is to handle that bubble, because this is where you make a lot of the returns in any cycle. And that is the point that needs remembering as well, that being out of the market's often a very painful process at this point in time for a lot of people. And I think that is something that a lot of people are grappling with right now. But you look at volatility, what is also interesting at the moment is that there's not a lot of hedging happening. The volatility remains very low across a series of asset classes. Yeah. And you wonder what that also signals about people's sort of reaction to risk right now. We don't need to hedge the downside.
Here's a retro theme. Trade.
I don't think it's that retro.
I mean, my memory is short. I'm like a goldfish. But yes.
It is. And there's a couple of interesting things happening here. in terms of the trade story, you've got the United States now looking at sort of medical devices, robotics. This is under Section 232. You're going to see a reaction potentially on the trade front when it comes to that in European stock prices this morning. But I think the bigger picture here is China saying that its manufacturers should avoid a price war in America to preserve the fragile truce that exists on trade. But that's just the first step. The second step here is what is now being called the China Shock 2.0. And Goldman Sachs has been writing about this and looking at who could be who could be most affected by this. And remember, the trade shock 1 came after 2001 when the Chinese joined the WTO and you saw the world flooded with Chinese goods. That is now happening again. Germany, they cite as being one of the biggest potential losers as a result of the China Trade Shock 2.0. They think it's going to be deflationary in Europe, which is going to be something for the ECB to handle, but it's going to have a big impact on employment. And that takes us to the car sector this morning. Look at the car data. We'll come back to that in a few minutes' time. Who's done well this morning? BYD.
Yeah, and this is China moving up the value chain and competing in product areas that Europe cares a lot about.
At the expense of Tesla in Europe.
Sure. But actually at the expense of Volkswagen and lots of other German manufacturers as well, Mercedes, all of these companies that are struggling at the moment, particularly with the ICE transition as well into EVs, they're struggling with that. BYD's coming in with really strong products. Do you need a Porsche Taycan or when you can buy a BYD? They both go pretty fast. That is the question that I think a lot of people are grappling with at the moment. And you do wonder, well, Goldman Sachs' research basically says Germany is at the epicenter of this action. How does the ECB deal with that if it's deflationary? How does the German government deal with that if it has a damaging effect on jobs? And German unemployment is going up.
Yeah, a question that's constantly recurring at that ECB press conference with Christine Lagarde. The other thing on her mind, of course, is the war in Ukraine. And we've had this tone shift this week, at least in the rhetoric from President Trump at UNGA. And we heard yesterday from Zelensky, Ukraine's Volodymyr Zelenskiy. He's talking about Moldova now, talking about the need for leaders to support Moldova because of this alleged Russian interference that we reported. Russia is planning in the election on Sunday to try to stop EU membership. So again, the problem's spreading around this area of the world. But we also had a really interesting interview with Kaja Kallas, the EU's top diplomat, speaking to Anne-Marie. She's been talking about how it's very positive that Trump's made these comments, but the bottom line is he backing it up with action? Doesn't seem like it when it comes to sanctions on Russia, doesn't seem like it when it comes to new support for Kyiv.
I thought some of the language coming out, some of the language that Zelensky was using was very candid about what it takes to compete right now when you've got Russia doing what it is doing in Ukraine, saying there are no security guarantees except friends and weapons. International law only works if you have strong friends, a sort of realpolitik check from somebody who's literally in the trenches.
If you read the US papers, though, this morning, they talk about the fact that the White House is signalling this is a negotiating tactic from Trump. He's trying to put pressure on Putin. He's disappointed. He's frustrated with Putin. This is a negotiating tactic. This isn't something that, to your point, that is ultimately going to get backed up in terms of new munitions and weapons and all the things that Ukraine needs right now.
Yeah, well, certainly.
Pressure on Russia, on Hungary, on Orban, then to stop buying Russian energy.
Yeah, and pressure that Trump has even said that he might start to apply. So we'll watch that one certainly with interest. That's an interesting dynamic. Now, investment giants have been grappling with the prolonged slowdown in deal making. That has been a feature of our conversations around this desk for a number of years, in fact. But there's talk about a renaissance in private credit in Europe as the sector's top players are keen to diversify from increasingly volatile US markets. It comes as the IPEM Private Equity Conference convenes in Paris. Chrissy Gupta is there for us. Chrissy, good morning to you. What is on the agenda?
Oh, good morning, Anna. It's a fascinating time to be in Paris because there's this big question of where does all the investment in Europe come from? If you were incentivized by the German government, the French government, the British government to bring in that money, how much of that is actually coming from the private market? Some would say as much as 80%. We're going to talk to some of the folks who are deploying their cash here. And it's not as simple as the roadmap we've seen in the past, where you make a stake, in a couple years you add value, and then you deploy it to the IPO markets. We know that's not a tried and true method in the last couple of years. So what do you do instead? And that's where Europe gets really interesting. They are literally forging the playbook in terms of new structures, new debt, ways to finance infrastructure projects that are really music to a lot of these European leaders' ears. So we're going to be talking to the likes of KKR. We just had a conversation with ICG in the last hour. We're going to talk to Carlyle. And I'm very excited in a few moments to welcome our folks over from BNP as well, talk about the French investment landscape specifically among the broader themes themes in defense and AI as well. It is a very exciting time to be in private markets. It's an even more exciting time to do it in Europe. So we're going to talk to the folks who are really helming the trillions of dollars that are being put to play on this side of the pond.
Got to watch that very carefully. Kriti, looking forward to all the great interviews you've got lined up throughout the show, throughout the day. Kriti Gupta at the IPEM conference taking place in Paris. So who have we got? Isabella Skimana, AXA IM Alts CEO, will be joining Kriti very, very shortly. Brookfield's head of Europe, Sikandar Rashid, will be joining her a little bit later on as well. What else have we got coming up on the show? Remember, it's a SNB decision today. Carsten Junius, Bank J. Safra Saracen, chief economist, joining us to talk about that. And AJ Rajadiachka, Barclays Global Chief Research Chair, is going to be joining us. New note out this morning, definitely worth a read. We'll delve into that a little bit later on, Lizzie.
On the daybook, guys, you mentioned we've got that SNB rate decision coming up. Then that's at 8:30 a.m. London time, so during this programme. Then at 1:15 p.m. UK time, we're going to be hearing from Stephen Miran, of course, the new addition to the Federal Reserve. He'll be speaking on Bloomberg TV. At 1:30 p.m. we'll get the latest US GDP numbers, the second quarter, third print, and then at 1:30 p.m. as well we have the durable goods orders numbers, and then also US jobless claims numbers too.
So we focus from a data perspective then on some of the US data. I think the conversation that the team is going to be having with Myron is going to be really interesting. I was struck by how, a few guests this week have talked about actually conventional policy from the Fed. Yeah. The Fed's policy looking quite conventional. So, how conventional does he seem in conversation, I think, is something really interesting to explore.
Markets are banking on 100, 150, 200 basis points being cut over the next year. New Fed chair coming in next year. The downside is definitely there. Who will that Fed chair be? And is Myron just the kind of precursor to that narrative? What he's saying is basically what the next Fed chair will ultimately deliver upon.
Break-evens remarkably steady.
No,
does that just suggest that everything's fine, as you say, Anna? We're just going to have someone pretty straight-laced and it's all going to be as it was?
Yeah, that's what the Trump administration looks like. What else do you need to know this morning? Let's walk you through the Thursday news. Spanish Prime Minister Pedro Sanchez says he will run for re-election in 2027. That's despite the polls showing his Socialist Party would have a difficult time winning a majority in Parliament. He announced his plans to Bloomberg News editor-in-chief, John Micklethwaite.
Yeah, I will do it for sure. This is something that I have already spoken with my family and with my party, and if they allow me, I'm confident that we can repeat a majority and to keep the work ahead.
Sanchez also weighed in on the need for stronger unity when it comes to European markets.
What we need to do within the European Union is to do our homework, as the former central banker Mario Draghi always reminds us. And that means that we need to deepen single market, that we need to review our competition policy in order to scale up big companies in Europe and try to be, as good, as competitive as global corporations are in the US.
In other news, HSBC says it's achieved a world-first breakthrough in deploying quantum computing in financial markets. One senior executive is describing it as a, quote, Sputnik moment for the industry. The lender says it used IBM's most advanced quantum processor for a 34% improvement in predicting bond prices. It's the first time any bank has used real trades at scale to demonstrate the edge offered by this emerging technology. And we were talking about it just a moment ago. European new car registrations rose in August by 4.7%, with Germany and Spain leading the gains. Sales of fully electric and hybrid models continue to pick up. However, consumer appetite for more affordable EVs has led to a 22% drop in Tesla sales on the continent, while BYD has tripled its deliveries.
Coming on from the programme, Ukrainian President Volodymyr Zelenskiy issues a warning to Europe at the United Nations General Assembly. We'll have more details on what we've been hearing from Washington. Plus, Swedish fast fashion retailer H&M posts a beat in third quarter operating profit this September, looking very much like last September. Another line standing out on the Bloomberg terminal this morning. We'll be keeping an eye on that stock at the open. Up next, we're out once again to the IPEM conference. Kriti's going to be sitting down with the head of AXA IM Alternatives. If you have questions, if you want to get involved in that conversation, any of the other conversations around this desk, ID plus BBTV Go is the function. This is Bloomberg. Welcome back, everybody. This is the opening trade, 7:17 here in London. Now, the AI boom has made its way into the credit markets. Oracle sold $18 billion of US investment-grade bonds on Wednesday, the market's second largest deal this year. The borrowing frenzy brings to light the current funding gap of AI investment pledges. Let's bring in Bloomberg's Valerie Titel, who has plenty of ideas as to where all the money is going to come from. Valerie.
Well, I'm relying on some analysis done by Morgan Stanley for this, Anna. This is what Morgan Stanley is arguing. Of the near $3 trillion that's been promised into this AI capex spending, yes, half of it will be covered by cash flows of those hyperscalers, but they are predicting a mammoth amount of that going into private credit, near $800 billion flowing into private credit to finance this AI funding gap. That would nearly increase the size of the U.S. private credit market by 50%. They also see $300 billion of that flowing into other private vehicles like private equity and venture capital funding. But this is just another example of whether or not this is a mammoth bar for the AI race, this AI trade, when it comes to their funding needs. Because if you take this all together, what Morgan Stanley is arguing is that there is a near $1.5 trillion funding gap between now and 2028. To put that into perspective for you, Guy, $1.5 trillion is near the size of the U.S. government budget deficit of last year. That is what the AI trade is looking to finance in the next few years. And then to connect this to the wider monetary policy discussion, is this borrowing binge something that can push up interest rates meaningfully without entailing a boom in job creation? Because we know that this AI trade isn't necessarily a labor-intensive boom behind it.
Does it suck available credit away from other parts of the economy as well? I think it's something that you need to pay attention to. Is it going to make it more difficult to do other things in the United States as this becomes all-consuming? Valerie, thank you very much indeed. Great place to start our next conversation. IPEM is underway in Paris. Kriti, of course, is there. Kriti, over to you.
Guy, thank you so much. As you said, we're in Paris, live at the IPEM conference, having a conversation about similar to what Valerie was just talking about, this idea of how you finance investments. We've got the perfect guest for that this morning, BNP's head of alternatives. Post the tie-up of their acquisition of AXA IM, we have Isabel Samama, who oversees about 300 billion euros of investment and now oversees what is the new division post that acquisition. I'm thrilled to welcome her to Bloomberg Television. Thank you so much for your time this morning.
Thank you for welcoming me.
Of course, we're thrilled to have you. Let's start with where we are. We're here in Paris. We're here in France. There's a big conversation right now about the investment landscape here. How are you thinking about how easy or maybe how hard it is to invest in France?
Well, France is only part of Europe, so for us it's probably 20% of our investments. So there is probably a little bit more regulation in Europe globally, not just in France, compared to the US, notably. That is the biggest market. But the way we look at deploying capital is more driven by asset class, by the opportunity. We have presence in 16 different countries, so we really make the arbitrage. And yes, we have just recently invested in France in renewable energy. We are deploying a lot of capital on student accommodations. So, but it's really driven by the opportunity, the arbitrage we can make, and where we see relative value.
I want to broaden out the conversation to your broadly, but before I do, there's a question right now in the private markets around a potential wealth tax, not just in France, but across Europe. Does that disincentivize some of the deal making you're seeing?
Not yet. Of course, yes, what investors like is stability regarding the fiscal regime. So everything that is new, changing, and yes, it can encourage, push the capital to relocate from other jurisdictions in Europe. So if it happens in France, so that's something we will monitor. But at the end, the capital, yes, move from one country to the other. So yeah.
Well, Isabel, your business has a lot of exposure to the private credit markets. Ahead of you, we were just having a reporter walk us through some of the deals that are happening in the public credit markets. There's a concern that as private credit ramps up, as private debt ramps up and really becomes the key financing solution, not just globally, but more in Europe, where the capital markets perhaps aren't as strong as the United States, does it add systemic risk at the end of the day?
Well, I think the boom for private credit, notably, is due to the fact that there is more and more disintermediation, and we used to look at private credit with only looking at direct lending, and it's a 2 trillion market. It has been disintermediated by asset managers over the past decades, but now what we are looking at when talking about credit is not just this 2 trillion market. It's the 40 trillion market that encompasses everything that is asset-based lending, and it covers a very wide range of credit. And there is, notably in Europe, what is interesting when talking about Europe and talking about credit is the fact that banks being more regulated, there is this play where banks are also encouraged to work with asset manager and to recycle their loan production, their loan book, and not just the direct lending that are completely now intermediated or directly managed by an asset manager. But it's interesting to see this trend that is there. From banks to find and to define partnership with asset manager to more actively manage their portfolio. And the regulation in Europe being more constrained, there is some opportunities that are more European driven. I have in mind the significant risk transfer that is for us a very big business, and this is definitely driven by the European regulation.
Well, it's fascinating that you say that, because it's such a pillar of the way these private markets work and the fallout of the GFC that has now grown into this new structure. I think when we're talking about innovation in the private markets, you're doing something interesting in terms of deploying in things like insurance money and insurance companies and partnerships there. Is that the future of private markets, deploying some of that when it comes to insurance companies specifically?
But the future of private market is to finance the real economy and to find capital that, want to be allocated to those asset classes, so requiring less liquidity compared to what you can do on the public market. But when insurance are just part of the market, as well as a pension fund. So we are in a group that is that has a big insurance business. We are coming from AXA, and we continue to manage the AXA balance sheet, the AXA capital. So insurance for us is a very big market, but as well as pension funds that are also a very big source of capital for us, and also wealth management that is growing. So. What's happening with insurance is we've seen all those private equity managers buying insurance book. That has been a way to really to distribute their own product. We are more, part of an insurance or banking/insurance group, but managing them.
Well, very quickly, does that at all increase the systemic risk if you're tying the private markets in with the insurance business?
It could, but I think it's more something happening in the US than in Europe. But yes, it could. As anything that where you have too much capital floating somewhere, it could generate some significant risk. And yes.
Isabel, lovely to see you. Thank you so much for your time today.
Thank you.
We really appreciate it, of course. Isabel Samama there, overseeing about 300 billion euros of capital, the tie-up, of course, between AXA IM and BNP. And it's really this kind of innovative structure that you are starting to see in the private markets, based here in France, broadening out to Europe as well. When it comes to financing and closing the sovereign financing gap here, that's something that Europe really sets itself apart from in terms of the global sphere, away from the States. Whereas the U.S. is talking about democratization, Europe is looking for that investment, and the private markets are the place to do it. We're going to have more conversations coming up for you live from Paris at the IPEM conference. Stick with us. This is Bloomberg.
Thursday, the 25th of September. Good morning. We've got 30 minutes to go until the start of trading for equities here in Europe. And the picture in the futures world looks like this. Fairly flat, down a little bit, but not by much. US futures are fairly mixed. The Nasdaq looks a little softer, but flat. The S&P may be a little bit more positive as well. We await the next catalyst. Equity markets have been a little becalmed over the last couple of days, but individual stock names have been bouncing around all over the place, particularly when it comes to the AI trade. Lizzie.
Taking a look at what's happening in your bond space. the moment. We've got yields higher a touch across the curve, across the European continent, but not a whole lot of movement happening here at all, Anna. We've got a very light day today when it comes to economic data. We've already had the German car sales numbers, but really it was a lot more yesterday and the day before when it comes to economic data.
OK, so those are the markets. That's what we are watching right now. Let's focus on something else that's going to be developing as we go through this programme, and that is that the Swiss National Bank is going to make a rate decision today. It is nearly unanimously expected by economists to maintain its current policy stance in just under an hour's time. Let's bring in Carsten Junius, who's chief economist at J. Safra Saracen. So, Carsten, very good morning to you. Let's deal with the basics then. I think all 24 economists surveyed, or at least 23 out of 24, Carsten, have told Bloomberg they expect a hold. I'm assuming you are in the hold camp as well. If so, give us the argument.
Well, absolutely. Well, the SNB doesn't mind surprising market, but this is really not the time. We have an expansionary policy already. Let's remind everyone, a policy rate is zero. That's clearly petrol neutral, and that is already stimulating the economy. That will push inflation up further into a slightly higher territory next year. So I don't really see a reason why they should change the stance.
OK, well, in that case, normally we might then move on in the conversation, Carsten, but we know that the SNB has the potential to surprise. It has done in the past. And I'm actually looking at some research by Morgan Stanley, an analyst there, which found that, you know, the SNB holds fewer meetings than other central banks every year, but they have the capacity to surprise more. And so does that make you a little nervous? Is there, do you have any fears? Is there any justification for a rate move this time?
Well, see, we have the tariff shock from the US, so that is impacting the economy, and they will definitely discuss how to deal with that shock and whether monetary policy could help in this case. And so it's not that they are just coming and going, saying everything is fine, and we stay at zero. We have shocks to digest. We have a strong exchange rate. And so there are also reasons why they could cut. But then let's think about it. First, cutting into negative territory while you are negotiating with the US about lower tariffs is politically not really wise, I would say. The other thing is that all this tariff shock is only impacting a very small part of the economy, as the main export goods, pharma and pharmaceuticals, are exempt from this 39% tariffs. And the sectors that are facing these tariffs just make up 4% of GDP. So I think these arguments will need to be discussed. It's also that the labor market is still deteriorating. But again, I think with 0% policy rate, the SNB is already there that they can fight those challenges.
There are other factors which are affecting the Swiss economy at the moment. So let's talk about how the SNB is likely to view those. We've just got a note out from FINMA, the financial regulator. UBS's emergency plan could not be executed, is the red flash that has just come across the screen. How is SNB policy in any way being impacted by what is happening with this debate around UBS's future within this economy? It is such a big feature of the Swiss economy, and I'm just wondering if there is part of the conversation which will turn towards this.
Well, see, one part of the policy discussion they usually have every 3 months is financial stability, and UBS is a big part and big concern for them. And they usually answer it in a way that they don't want to create any financial bubbles, and especially no bubbles in the real estate sector. And I think that already, again, is another reason for holding interest rates constant and not cutting them into negative territory, as we see that credit growth for mortgage purposes is increasing sharply again. We see that real estate prices are also rising quite a bit recently, as there's a lot of demand for housing. So you don't want to fuel that bubble and risk that it is imploding at some point in time.
Yeah. But it's the Swiss economy. When they think about the Swiss economy and the stability of the Swiss economy, FINMA is basically saying that UBS is too big to fail, that this is too big a risk almost in some ways for the Swiss economy to carry. Do you have some sympathy for that view?
Well, I totally agree with that view, but hey, it's a small country and we have big companies, and yes, it's an outside risk. And in case anything would happen to UBS, I'm pretty sure that the state would have to jump in. Is it avoidable? No, I don't think it's avoidable. It's just a risk that you're taking. Of course, you could downsize UBS, you could sell it to foreign competitors, but does this make Switzerland better off? I doubt.
Carsten, what would you need to see in the data to change your mind on negative rates in the next few months? Do you not see any pressure for the SNB to follow the Riksbank and the Fed in their cuts?
Well, see, I think the difference to the Riksbank and to the Fed or to actually most other central banks is that we already have very expansionary policy right now. So we are in a very good place. Still, of course, something could happen. One thing, obviously, would be exchange rate. So in case the exchange rate is appreciating sharply, and not only versus the US dollar, but versus the euro again, then we would have a lot of deflationary pressure coming in through the already negative import prices, and that could change the picture. Also, if for whatever reason the economic development turns out to be more affected by these tariffs, such that we slip into a recession, which so far we really don't have. That could change the picture, and then I think the SNB wouldn't be shy of jumping in. My view is that if they do something, they are not cutting by 25 basis points only. They wait until they have enough reason to cut by 50 basis points, as their communication as of late always has been that these negative rates come with negative side effects or unwanted side effects, that they're not really appreciated by anyone in the economy or in the public, that savers suffer from it. So if they go negative, I think they should do minus 50 basis points in order to provide a big move in case that will be needed in the future.
OK, so if they go, it'll be going hard. You mentioned the communications, Carsten, and I just want to talk about the idea that they're going to publish what are effectively minutes, but it'll be a month after the decision. This is a new thing for the SNB. Do you think that that's actually going to be helpful to investors, or do you think that this is just a long, late press release, the same thing as before?
Well, it is a long, late press release, and I'm not sure many people are reading it, but those that really try to understand the SNB better, for them it might be helpful. And you mentioned in the beginning that there have been a lot of surprises to some analysts, and and I see this in my conversations over here frequently. People don't really understand how the SNB is coming to their interest rate decisions, what they are really looking at, what their processes are. And I think the minutes are an opportunity to make a bit clearer how they are thinking, how they are working, what they are looking at. And the quarterly bulletin or what all the other things they have are really not a substitute for that. Minutes can show the discussions. Minutes can show what arguments are weighted against each others in a way that a press release or the quarterly bulletin wouldn't be able to. So in that sense, I think these minutes will be helpful.
Yeah. Carsten, how are high US tariffs impacting the Swiss economy right now?
See, I strongly believe that they will push unemployment rates higher. We are currently at 2.8%. We are probably moving to 3.2% next year. So they are definitely reducing export demand. But let me focus that in certain sectors. 64% of Swiss exports to the US are in the area of pharmaceuticals and chemical products. So far, these products are exempt from those tariffs. And tariffs facing sectors is mainly watches, which is important. It's food, so like Nestle, even though they produce a lot of stuff over there in the US already. And it's the mechanical industry. So specialized machines and all that. So all they are impacted. But what I also hear from some companies is that their main competitors are in Switzerland are not facing the same tariffs. So I have the impression that Switzerland has very strong pricing power, and some companies simply continue as they did before.
Interesting how that feeds through into inflation. Carsten, great stuff. Thank you for catching us up on all of the aspects we're going to be thinking about as we work our way into this decision from the SNB. Carsten Junius, Chief Economist at J. Safra Saracen. We're expecting to hear from the SNB President, Martin Schlegel, on Bloomberg later today. Stay tuned for that interview. Also on Bloomberg Television, we've got an interview coming up with the new Fed Governor, Stephen Miran. Don't miss that conversation. He's joining the surveillance team a little bit later on. I think that conversation kicks off at circa 1 p.m. London time. Lizzie.
But coming up right here on this programme, we're going to be watching European autos after car sales edged up again in August. We already saw German autos gaining on US cuts to tariffs on EU cars yesterday to 15%. We'll talk about that and your other stocks to watch next. This is Bloomberg.
We have already lost Georgia in Europe. Human rights and the European nature of the state system are only shrinking there. Georgia is dependent on Russia. And for many, many years, Belarus has also been moving toward dependence on Russia. Europe cannot afford to lose Moldova too.
Ukrainian President Volodymyr Zelenskiy speaking there at the UN General Assembly, urging the European Union to provide Moldova with funding and support for its energy sector. Let's get more now with our Europe correspondent, Oliver Crook. Ollie, we've heard there Zelensky warning on Moldova. It comes as President Trump's been shifting his stance on Ukraine as well. Just put it all together for us.
Yeah, Moldova is sort of an interesting example here, and there's a lot of vested interest in it. Obviously, the Ukrainians are very interested because it is in the southwest side of the country. They're sandwiched between Moldova and Russia. And right now, Moldova is in this sort of tug of war between influence from the European Union in the western side of things and, of course, the Russians. We had a lot of reporting on it this week. Alberto Nardelli had a great story where he saw some of the documents and the plans of how the Russians were working to sort of undermine the elections, which are happening this Sunday. And really, this Sunday's election could really determine in some way whether or not Moldova will ultimately join the European Union, which is why it's seen as so important for the Ukrainians, so important obviously for Moldova, but important for the European Union and for Russia. The European Union still trying to show that it has the draw, that it can continue to bring countries in a sort of coherent way that will keep the bloc happy. Russia, on the other hand, trying to say that, this is sort of a failed project and this doesn't basically, work very well. So for the parliamentary elections that are going to be held on the Sunday, absolutely critical for the path forward. And of course, it's the same sort of setup we've seen in many of the Eastern European countries where you have a lot of interference, the EU says, by the Russian side of things, a lot of promises by a populist sort of a party that says, they're going to give out sort of free cars to large families and large sort of sums of money, these sorts of things. And that'll be all on display in the fight, a sort of proxy battle over Moldova over this weekend.
Ollie, there seems to have been a tone shift from the US president over the last 48 hours when it comes to Ukraine. The real question I think a lot of people in Europe are asking is, are we on the hook for this? Is the US going to provide any kind of support? What does this tone shift actually mean? Are you beginning to hear any answers to that question, or is it still just the question being asked?
Yeah, to the question being asked, is Europe basically the ones on the hook? The answer is absolutely yes. The question is whether or not they can enlist the American momentum from time to time when it's there. I think the Europeans are very wary of basically relying on the Trump administration, relying on it in terms of the architecture for what they need to do, but they really want to be able to take advantage of it in the moments when it is present. So how are they going to do that? Potentially, they can get the United States and Donald Trump to put a bit of pressure on Hungary and Slovakia to maybe stop buying the Russian fossil fuels, but that is really the quandary before the Europeans. And we've heard it, even from senior officials within Germany, that basically Friedrich Merz, the chancellor, doesn't really have any faith that the U.S. position is going to be stable. That being said, I think the Ukrainians and the Europeans are very welcome to have, at least rhetorically, the U.S. on their side. Whether that translates into sort of stronger action from the United States is another question. At the end of the day, the Europeans need to pony up the cash if the United States is still willing to sell the weapons, which at this stage they've made very clear that they are.
Ollie, thanks very much. Bloomberg's Oliver Crook with the latest then on the Ukraine story and related news flow. Let's go from that to the markets, though. We're joined now by our Markets Live executive editor, Mark Cudmore, with 3 minutes on the markets. And the markets focus a little difficult to pin down, it seems, Mark, today. Lots of disparate conversations happening. I know that you're drawn to thinking about the relationship between the dollar and rates, and you see something interesting there, especially coming up to month end.
Yeah, so a couple of things here. I think, first of all, the macro community is starting to warm up to the idea of playing for a bit more of a sustained dollar bounce. Now, short term, that is kind of helped by the idea that into month end, the monthly rebalancing flows should be positive dollar at the margin, which might feed that theme a little bit more. Some of the narrative around this is that, the dollar really hasn't been able to break lower, even though we saw US yields kind of crater in recent weeks. And therefore, that kind of an asset which can't go down means it's probably ripe to go higher. The short-term market might be kind of over-positioned short, even though the structural market's still very long the dollar. So I think that there is certainly a possibility that we do get a bit of a dollar bounce. What's interesting now is what that means for other assets. I think it could finally mean this time for gold to have a short-term correction. Does it mean risk off for stocks? That's where a bit of the debate is. My view would be this is not necessarily a risk-negative catalyst more broadly, unless it's a very fast or quick dollar bounce, and that doesn't seem to be the case at the moment.
I'm searching for something that is going to change the narrative at the moment, Mark, and I'm wondering what that catalyst looks like. And you and I discussed, I think it was yesterday or the day before, black swans. We don't know what a black swan looks like. But do you get a sense that with a lot of assets doing interesting things, look at what is happening in crypto, look at what's happening with the dollar, look at what is happening with AI trade, that some of what is happening at the moment is not sustainable. And I don't know which bit of it is. And that's the bit that I'm struggling with at the moment.
I hear you, and this is what everyone's kind of looking at this market. So there's two ways to look at this, two things to look at. One is there's external catalyst and internal catalyst. An external catalyst can be scheduled risks or known kind of things on the horizon. Most of those people are not worried about those scheduled ones. Sure, there's going to be a government shutdown, but people don't really think that's going to derail the risk rally or the current trends. So you're looking for external risks to have to be black swans, which means we can't predict them by definition. Now, the other chance is an internal dynamic, as in just the price becomes its own self-fulfilling narrative. And that's what you're kind of seeing a bit in crypto at the moment. You're getting a little bit of shakeout at some of the alternative coins because they just went too far too fast. Maybe that spills over to some of their assets. And that's where the dollar story comes into this, because if you get a bit of a dollar bounce fueled by people looking for a new theme to play, and the fact that yields may have bottomed for now, and the fact that we've got month-end rebalancing kind of feeding it, maybe that could feed through to other assets. But I'd be reluctant to put too much kind of conviction on that idea that we're going to get a self-fulfilling price-led move, which means your base case has to be that the current trends continue for now until we see that external catalyst. But if there is going to be an internal change, it's going to probably come from the dollar.
All right, our Bloomberg Markets Live executive editor, Mark Cudmore. By the way, JP Morgan Chase's Andrew Tyler had a note yesterday saying there are lots of conversations going on right now about what would stop this bullish run. He says one of the favourite responses of his was an asteroid hitting the Earth. So we'll keep an eye out for one of those. But remember, you can get up-to-date analysis and insight from Mark and his team by going to MLIV Go on your terminal. Let's now go to our individual stocks to watch with Chloe Melly. Chloe, what are you watching?
Good morning, Lizzie. So it could be a good morning for European car makers today. So European car sales rose for the second month in a row in August. And that is because there was quite strong demand for electric vehicles and hybrid models in particular. And that is good news for those European car makers that have been really trying to compete with their Chinese rivals that are cheaper and really making inroads increasingly in Europe. So let's keep an eye on some of those key stocks. We've got Volkswagen, Stellantis and Renault, for example. Volkswagen is particularly interesting to watch, given that it has been outperforming its peers, but it's also the parent company of Porsche that has been having to roll back some of those EV ambitions because that luxury end of the market just isn't gaining traction. So quite an interesting story there in terms of affordable versus luxury EVs. So let's keep an eye on that. Moving on to some tariff news. It had been a bit quiet on that front, but now the Trump administration is setting the stage for potential tariffs on robotics, electrical machinery and also medical devices. So let's keep an eye on Siemens Healthineers and Philips in that medical device sector, and also ABB and Schneider Electric in more of that electrification automation sector. ABB is the one that has been doing the best, so let's keep an eye on that. And finally, let's take a look at Dassault Aviation. The French defense company said that it is happy to go solo for the French fighter jet program. Sorry, the European fighter jet program is developing in collaboration with Airbus. So we'll see if the market reacts positively to that. This is a fighter jet program that has been under a lot of tension, and Germany said that it is considering ending that partnership because Dassault wants to take too much of a role potentially. So we'll see if investors believe that it can actually go solo for this fighter jet program.
Chloe, thank you. Our equities reporter, Chloe Melly, of course. Let's remind ourselves that yesterday we saw copper prices surging on the back of force majeure at a US producer, and that pushed basic resources stocks to the top of the stock 600. So that's sort of a yesterday theme that you never know might come back either in the same or a different direction. We will be back with the market open. H&M earnings, watching UBS. This is Bloomberg.
Okay, here we go. Thursday session almost upon us. Let's talk about where we were yesterday. European equities faded a little bit into the close, but we actually broadly rallied into the close at the end of the session. What I think is interesting here is the US session. Tech was down, except for Tesla, which had a pretty good day yesterday. Tech was generally down. Names like Nvidia were soft yesterday. The big hyperscalers were all in the mix yesterday. So a little bit of a pause maybe on that breathless rally that we've seen in tech stocks. Over the last couple of days, we're down on the S&P circa 0.8–0.9%. So a little bit of a pause yesterday. What does that tell us in terms of the pickup this morning? Lizzie, what are we seeing?
Yeah, the first back-to-back losses of more than 1% in 5 months for the S&P yesterday. So that negativity looks like it's going to continue in today's European session. We're read across the screen here. Particular underperformance expected for the FTSE 100. We had outperformance for the London miners yesterday off the back of the copper news that Anna had mentioned. This mine in Indonesia and force majeure declared on some of its contracted supplies. That boosted the likes of Glencore yesterday. Do we see a reversal of that in today's trade, Anna?
Let's have a look at some of the other sectors and stocks that could be in focus then, Lizzie. And we've seen the Trump administration being busy with the Section 232 investigations once again, this time into robotics, industrial machinery and medical devices. We put robotics on the list, but you could add medical devices, the likes of Philips, perhaps Smith & Nephew, those kind of businesses. UBS also in focus. They have a policy, just like lots of banks, for how they would be resolved in an emergency. And must try harder seems to be the verdict so far from FINMA, but both sides seem to still be talking to each other. And H&M storming past estimates when it comes to third quarter margins and profits, Guy.
Absolutely. What is interesting is the top line was actually fairly static. They're doing well on the margin front over at H&M. OK, here we go. Let's talk about this market Thursday morning. How are we opening? We're expecting a slightly softer open this morning, feeding off maybe what we saw stateside yesterday. So the FTSE 100 is a little softer, but as Anna's already indicated, keep an eye on what is happening with the mining stocks in that market this morning. So that's going to be something you want to roll in to that broader narrative. The IBEX is a little softer this morning. The stock 600, we don't yet have a fully sort of formed picture there. CAC 40, it's going to be interesting to see what some of the car stocks do this morning. I think that's going to be a feature of the German landscape as well. We've seen the data coming out of that. We'll keep an eye on the SMI. What does UBS do on the back of what we've heard from FINMA this morning? There's some interesting kind of idiosyncratic stock stories over sort of in this market, but the overall picture is one of what is being driven by this kind of tech narrative, this big story that is emanating out of the United States. Is Europe kind of missing out on that? Sort of feels like it at the margin. Does it persist into the rest of the year? That could be the defining factor. Lizzie, the stock sector story looks like what?
Well, we've got 3/4 of sectors in negative territory this morning. At the top of the basket, though, is basic resources. So we had the copper gains to about a year high, and this off the back of Freeport, as we say, having this mining incident in Indonesia. And you had the likes of Anto and Glencore moving off this yesterday. Today, Anto down 2.2%, Glencore up 1.3%, interestingly. Now, we're waiting for H&M to open, but we have got already moves for HSBC, down 1.1%. Anna, you would flag the medical device makers. This, as you say, off the news that the US is looking to maybe put tariffs on robotics and medical devices. We've got Smith & Nephew down 0.8%, but look at Philips here. They're down more than 3%. Convatec Group down 2.8%. Not a huge move for Oxford Nanopore, just down 0.3%, but definitely negative across the sector off the back of that tariff news.
Yeah, which strikes me as interesting. Philips make it of more of the machinery end of medical devices, and our story talks about syringes and sutures and things like that. But anyway, we watch with interest as these individual names respond to the Section 232 investigation now launched over in the US. I'll keep an eye on some of the automation robotics businesses, machinery businesses on the MDAX, and they don't seem to be responding all that much to the downside. So we'll keep an eye on some of the nuance behind this story, perhaps.
Car stocks coming back a little bit. Porsche's up, Stellantis is up. In terms of where the percentage change is coming through, it's not necessarily being reflected when it comes to the weight. Rio is the biggest weight sort of points gainer in the stock 600 this morning, followed by SAP, followed by Anheuser-Busch, which is interestingly trading very strongly. Names like Anheuser and British American Tobacco are both trading quite strongly today, which would imply some sort of a defensive kind of theme. But cars and resources stocks. So Rio, Shell, Glencore, all trading higher. Then you've got the kind of the big car names are all bouncing back. Is it on the back of the data? You've also got H&M just coming through. We're seeing a big move there. H&M is up very strongly. Yeah, look at that. So a very strong, margin number, really delivering a bottom line performance for H&M, because the revenue line is actually reasonably static.
And the very in-the-moment guidance looking at least not terrible. So saying that this September, this month that we're in right now, looks very much like last year. Yeah,
and of course we already had a positive signal from Inditex, the Zara owner, which typically outperforms H&M, but it looks more positive for retail from these results. And
it's interesting because that's it. So it's interesting that's not the message you hear in the UK right now.
No.
Which is quite dismal when it comes to the data coming off the high street. But clearly there's quite a sort of big global picture that is different. I wonder whether Europe is as strong as the United States, whether the United States continues to be strong. What is that? Because the consumer in the States is kind of what everybody's watching right now. Is there a signal in H&M as to what that consumer is doing at the moment?
I think we're going to dive into those results from H&M a bit later in the programme. But as we say, currently up more than 11%. Just finally, we've had a load of banking news this morning. And if you check in on HSBC, despite all this development when it comes to quantum computing, the stock down in London 1.3%. We had FINMA saying that this emergency plan of UBS's can't be executed. As you would expect, UBS shares down 1.2%. Let's get some analysis now, shall we? We have AJ Rajadakshi. Excuse me.
Not bad.
Yeah. We'll ask him
how would you rate that?
Verdict.
That was very good.
Oh, you kind AJ.
No, it really was.
Thank you so much. I'm so sorry for that. But we have AJ around the table with us, Global Chairman of Research at Barclays, and it's always a pleasure to have you on the opening trade, so thank you for making the time.
Sure thing.
Your investment outlook came out this morning, and I had a flick through it. You're positive going into Q4. We've been discussing whether this is a new normal, whether it's a bubble. Why are you convinced that this stock rally isn't a bubble?
Right. So in maybe 2 or 3 sentences, not to belabor the point, there's 3 big differences between 2000 and now. The first is that the tech sector now makes an enormous amount of money. Remember, the telecom sector in 2000, right, the sector that took on the debt that ultimately ended up going badly, operated in a low-margin, low-utility environment. I'm sorry, but 73% margins on NVIDIA are not low margin. That's one of the single biggest differences. The other is, we keep talking about valuations. The big six, 3 years ago, traded at a 39 to 40 multiple. Since then, Microsoft is up about $2 trillion in market cap. NVIDIA has almost doubled in market cap, but they now trade at a 28, 29 valuation. And what has changed is earnings have overpowered everything else. These companies make an enormous amount of money. And even though we classify them all as tech, they don't actually all do the same thing. NVIDIA sells to the others, but the others are in retail, they are in e-commerce, they are in cloud computing. It's a little unfair to almost lump them all as one. They don't rise and fall as one.
OK, so for you, it's AI the driver.
Yeah.
But then for many others, it's also the Fed cutting rates. So keeping all of that in mind, if the Fed doesn't cut rates as much as promised, can AI and earnings keep the rally going?
Absolutely. I mean, the Fed didn't cut rates for a year, and the rally kept going. Not only did the rally keep going, it kept going despite the single biggest global reordering of trade that we've seen in 70 years. Remember all the doom and gloom in April? We are up 35% since then. And most of that rally didn't happen with the expectation, oh, look, the Fed is coming to our rescue.
OK, so it wasn't all about the Fed expectation then, yes. So it was about, AI can do magical things, it would seem. Now, you're not as worried about the fiscal space that the US finds itself in as some others, AJ. Tell us why that is, because this is going to get a lot of focus, shutdowns in focus.
Because believe it or not, the United States did enact a tax hike. The United Kingdom has struggled to do it or to cut spending. The France has struggled. The Japanese have struggled. These are all economies with poor fiscal profiles, including the US, I'll grant you that. They are all economies, with the exception of France, where inflation is not yet at target, and they are all economies, with the exception of the United States, where there doesn't seem to be enough political will to do fiscal consolidation. Tariff revenues matter.
And I mean, Trump talks about tax cuts. So which tax hike are you talking about? The ones on international businesses selling into the US?
Just to break down the numbers, right? The United States imports $3.1 trillion in goods, okay? Assume tariffs went up on that by 15 points. That means someone somewhere is paying $500 billion. Most of that $500 billion eventually will end up getting passed on to the end user, regardless of what the president says. But that is a tax hike, and the US consumer has taken it on the chin and just not blinked. Our fiscal profile, coming into the year, if you had told me just the Trump tax cuts would have been extended, I would have told you we were looking at a 7 to 7.5% deficit for the foreseeable future.
But lots of people tell us that these tariffs are not being passed on to the US consumer, either at all or yet.
So we do have customs data, right? It shows that tariff revenues right now are running at $300 billion, and the effective tariff rate is 11%. The US government, regardless of who's paying it, is getting in $300 billion a year. And as those tariffs rise to 15, 16, that will go to 400, 450. That's $4 trillion over a decade. Even for a $30 trillion economy, that's real money.
So everything just carries on. We're good.
This is going to come back to blow up spectacularly in my face, but yes, I think so. Yeah.
For how long?
If I worry about something,
it
is that fiscal profiles outside the United States cause a global bond unraveling. It's not my base case, don't get me wrong.
Yeah.
But I do worry about the
You're talking about the UK here, aren't you?
I'm talking about France as much as the United Kingdom. So, and this is perhaps not the most politically correct thing to say, but 8 weeks ago, there was a lot of headlines in the UK about the Chancellor having an emotional moment. For me, the more significant thing was that the Labour government could not pass through the cuts to the welfare bill. And now she presumably has to find more fiscal, tailwind somewhere because the numbers have weakened. But France is similar. They are on their 5th prime minister in 2 years. They cannot pass a budget.
Why does this... do you think this has a meaningful effect into the States? As you say, the US in some ways is raising taxes. In theory, you'd think that would slow the economy down a little bit, but to your point, doesn't seem to be at this point in time. Why do I need... If I'm a US investor, why do I care about what these crazy Europeans are doing?
Because at the margin, global bond markets are correlated, and eventually if you get an unraveling in the 30 and 40-year points in the United States, in the United Kingdom and France, it's not clear that the Japanese are isolated, and Japan matters because the Japanese...
Where does this affect the US? Because the Fed's going to cut rates aggressively, right? Front end's going to come down. There's this whole talk of kind of doing QE, and that's going to keep the back end under control as well. Where does this... what is the vector?
If the Fed does QE, I will come back to this studio and eat this table.
Okay.
There is not a chance that is going to happen.
You realise this is on tape, Adrian?
Yes.
Right. Bruce Richards was here from Marathon going, they're going to do it. It's going to happen.
I mean, between the two of them, between the two of us, he has by far the better track record. I get that. But that doesn't translate into every single call. The Fed is not doing QE for the foreseeable future. It would be insanity. I mean, we are talking about an equity market that is already at an all-time high. The unemployment rate is at 4.3%. Inflation is not at 2%. What are you doing? I mean,
for the first time in this conversation, I think you're lost for words.
I completely am. The Fed is not doing QE, and just to connect it back to the U.S., the Japanese own $1.25 trillion of U.S. treasuries. And they don't have U.S. liabilities. If they start to sell U.S. treasuries because they want to support their bond market, that is the way that it passes on. I don't think it happens. But if there's something I worry, that's what I worry about.
Can I ask you how worried you are about central bank independence, not in the US, but here in Europe? We've got a meeting coming up between Nigel Farage, the Reform UK leader, and the Bank of England Governor Andrew Bailey. And the Times of London is reporting that actually he's going to urge him to cut rates. Surprise, surprise, it's the Trump playbook. When you've got the rise of right-wing politics here in Europe as well, do you think it's going to be imported, the risk to independence of central banks?
So I'll say two things. One is that US bond markets, believe it or not, are not worried about central bank independence in the United States. The day that Governor Cook was let go, right,
she's fighting to stay.
She's fighting. She's won 2 rounds of cases so far. But that day, you would have expected inflation break-evens to widen. They did not. They actually came down. Okay? It seems the bond market in the United States seems very confident that the institutions will hold. The United Kingdom, the central bank has always been a little more beholden to Treasury than in the US, the way things are set up. But yes, if you go down this path, I would worry a little bit, because inflation in the UK is not at target. It is an island. It imports a bunch of things. Currency weakness passes through to inflation very quickly. So if you go too far down this path, it starts to become a problem.
But is the reason that break-evens are steady because they think that the next Fed chair is going to be orthodox, or is it just that the market doesn't have any idea how to price all of this?
I think it's because the market believes that the institutions in the United States will hold, that the bond market is the final arbiter. And 3 times in 2025, the president has threatened to get rid of the Fed chair. And each time when the bond market, started to get upset about it, he backed off. So I think that is what markets are banking on.
You've woken everybody up with the finger snap. I love it. We love to have you. Hopefully you'll never have to eat a table on this show, but we will hold you to it. AJ Rajadiaksha. On the show for us, Global Chairman of Research at Barclays. Thank you so much for joining us. Let's go to the Core 6 guy.
Let's talk about what's happening in the markets this morning, get a quick snapshot of what is going on. Let's talk a little bit about the main movers. As you can see, there's an awful lot of red out there this morning. Defence stocks are definitely giving back some ground. The AI trade is giving back a little bit of ground. ASML, Schneider are both soft this morning. You've also got weakness in the pharmaceuticals sector. There is strength out there. It's just not on this board. It is in the auto sector, surprisingly. It's in the mining sector, rather surprisingly. Let's get some details on what is happening therefore there. Chloe Melly's got all of that.
Good morning, guys. So let's start with some mining movements this morning. Rio Tinto and Glencore are both up this morning. The U.S. company Freeport announced that it was suspending a mine in Indonesia following an accident, and that will therefore reduce near-term copper output and therefore push up those copper prices. And that is benefiting those 2 names this morning. We've got Rio Tinto up almost 2%, a little bit more of a modest move in Glencore, but a little bit of a movement there this morning. Moving on to car makers. And the car-making sector is doing quite well. It's quite rare to see such positive movements in that industry in Europe. But there's 2 things. So there is the European car sales that have risen for the 2nd month in a row in August. And then there's also the fact that the lower U.S. tariffs on auto imports of 15% are now in place. They have now taken effect. And that is really moving the shares higher for those companies this morning. We've got Volkswagen, Stellantis, Renault and BMW. We've got green across the screen there. Moving on to another sector, but that is not so lucky with tariffs. We've got some downward movements across this robotics, medical devices and industrial machinery sector, because Trump is setting the stage for potential tariffs on those sectors. So we can see Philips, for example, their medical device maker, down almost 4%, and also down movements in Siemens Healthineers and Convatec, as well as Smith & Nephew. So a little bit of a red there. And finally, let's end on H&M. H&M is up 8.3% this morning. Its quarterly margins and profit were way ahead of expectations, and that is thanks to really good cost control and also a refocus on its core H&M brand. And it's being rewarded by the market quite a lot this morning.
It is. Chloe, thank you very much. Chloe Melly from our equities team. With that look at plenty of stocks on the move, in fact. And Chloe ended there with H&M. We'll pick up that theme shortly. We'll take a closer look at those H&M numbers, the outlook for the business, the third quarter profit beat, what it's doing on cost control seems to be important. News from Milan Fashion Week also may get a mention. We'll be back with more on that. This is Bloomberg. Welcome back. This is the opening trade. We are 19 minutes into a session that looks pretty negative, actually, for European stocks, down around 0.5% on the Stoxx 600. And most sectors in negative territory, including construction and materials. That's the worst performing sector this morning. So we'll continue to watch that as basic resources and autos have a day in the green. Now, Bloomberg understands that Intel has approached Apple about securing an investment and discussed how to work more closely together. For more on this, let's bring in Bloomberg tech anchor Tom McKenzie, who's with us. So why is Intel approaching Apple then, Tom? Because they used to have a very close relationship. Intel made their chips.
Yep.
That's not the case anymore. And Intel's just making friends with everybody right now.
I mean, what a turnaround in the last few months for Lip Bhutan, the still relatively new CEO of Intel. Given that investment, about a 10% stake from the federal government, about $5 billion from NVIDIA, about $2 billion from SoftBank, and now looking to court Apple, who, as you said, used to, of course, use Intel chips. No longer. They're now produced by TSMC for Apple. They have their own in-house designs. So they're looking potentially, we know that our reporting has told us that they are in conversation. Whether that leads to an investment by Apple, clearly to follow on the lines of NVIDIA, is something that we're looking at. Liquidity is less of a challenge now for Intel. The bigger challenge is actually securing significant customers for its foundry business that Lip Bhutan is still committed to, but is much more cautious on. That would really be catalytic if Apple turned around and said, you know what, we might consider you as a producer.
You do wonder how these dinners go. You're at the White House, you're sitting there, you've got all of these guys around a table. Trump's just made a big investment in Intel. NVIDIA's just made a big... who's next? Like, somebody put up their hands? Is it kind of just go around the table? Who's going? I'm joking, of course, but there's a certain sort of feeling about that.
It's hard to see how politics is not part of the calculation. SoftBank, $2 billion. NVIDIA, $5 billion. Apple have committed $600 billion domestically in the US. This could be part of that $600 billion they've committed.
We should probably have talked about Oracle. That went well, yeah?
Oracle went very well. So they raised a little over $18 billion. Demand at one point peaked at $88 billion in terms of this debt sale.
Yeah,
across 5 times. Yields, of course, given that demand, yields were lower, about 1.37% above the equivalent. That's on the 40-year, because they went all the way up to 40-year. It's worth noting that Oracle went cash flow negative this year for the first time since 1992. Analysts don't see them going cash flow positive until 2027, as they spend on these data centers to fulfill those commitments to the likes of OpenAI and Meta.
And then we've got to talk about HSBC, because they've had a Sputnik moment when it comes to quantum, they say.
Yes.
And yet the stock was down when I last looked, 1.5% down this morning.
Yes, so this is using quantum computers, which are large and expensive and quite volatile and have been in this research phase. But it's the first time they say that they've been able to use real data, not live data, but real trading data at scale with a quantum computer, and specifically in this case to calculate how a bond will trade at a particular price. And the quantum computer was able to do that at 34% better than their legacy computers and their algo teams. Now, 34%, of course, in the world of investment banking, when you're looking for every margin, is significant, and that's why they've said this could be a potential Sputnik moment. We know JP Morgan, Citi and others are investing in quantum computing, and I think it raises a question as to when quantum computing becomes a real competitor for the cash flows that are currently flowing into AI. if this progresses?
You think of all the models that have changed the world, kind of Black Scholes, and how it's all changed the sort of pricing of options. And this could be amazing in terms of the arbitrage factor within markets. Tom, great stuff. Thank you very much indeed. So it falls to me to talk about fashion, which is a surprising thing, but I'm going to do it anyway. H&M shares are having a pretty good day this morning. The top line's actually reasonably static. This is H&M executing really strongly. So let's bring in Andrew Felstead to talk about all of this. That's what it looks like, because the top line actually looks kind of OK and pretty comparable, but it's the margin number that seems to have really ticked higher here.
That's right, although I wouldn't be surprised if they've got some help from the external environment, because we had very good... We had very good weather over the summer. You know, the sun shone at all the right moments for buying fashion.
Yeah.
So they probably won't have had to discount as much because you've sold things at the right time.
Yep.
I think the competitive environment could also be going in their favour. You've got Inditex Zara, which is really stretching upwards. You know, it's really trying to take the white space that's been left by the luxury brands.
Oh, yeah, I've seen jackets for like 300, 400.
Exactly.
Exactly. Lizzie's pulling her face.
Exactly.
Yes.
Exactly.
That's unprecedented.
So that leaves a lot of white space for someone like H&M. You've also got Primark. Primark don't have a permanent CEO. They lost their CEO, who was very good on product.
Yep.
And then in the US, you've got the crackdown on the de minimis rule, which is going to hurt Shein. And Temu. So you've got all these things, and you've got COS, which is having a bit of a fashion moment. It was in the
a good one or a bad one?
A good one.
Right. Okay.
It was in the list index of the most, in-demand brands. It was the only kind of high street brand that was there. You've also got this fashion change that I wrote about the other day, from sort of leggings, skinny silhouettes, to an oversized silhouette, which COS is very...
Can you have an oversized silhouette?
See, when I think of the cheaper end of the fashion market, I do sometimes think of leggings, but you say they're entirely out, and I need to catch up.
No, the death has been exaggerated, but they are definitely on the way out, and that's I think that's particularly helpful for COS. But so I think all these factors, H&M, as you say, has been executing well, but I think they have been getting help. Yeah.
Can we just leave fast fashion to the side for one moment and talk about the fact that it's Fashion Month, Andrea? We've got you on the show. How's it going?
Well, it's been very interesting so far. We had Burberry on Monday, which
the Fab Ladies were there in force.
Ladies. I was very surprised at what they sent down the catwalk. I know the catwalk is very divorced from what you find in stores, but they've been really majoring on outerwear on the check. There wasn't much of it in evidence. The big one has been Gucci. Gucci is under a new creative director with Demna Gvasalia, who I have to say I'm very sceptical about at Gucci, but he delivered. He did this bonkers film, which carried like a viewer discretion urge warning on it. It was crazy, but it's created a lot of buzz. It's very different. We've got some big catwalk debuts coming this week. We've got Dior, we've got Chanel. So it got in there first with something that was very different, something that was very shareable online. And we got a few hints of where he might go. He went back to the Tom Ford era. He went back to the Alessandro Michele, very successful era.
Guys lost. All you need to know,
like
watch out for Jonathan Anderson at Dior. I cannot wait. Andrea Felstead, I'm so glad we got to talk about this. Andrea Felstead from Bloomberg Opinion coming up on the programme. We're going to head back to IPEM in Paris and look at the role of private markets in Europe's AI infrastructure. That's next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, and it's red across the screen for European equities at the moment. We'll bring you the SNB decision in just a couple of seconds, but look at all of this. We've got retail, autos outperforming in the sectoral basket, but you wouldn't really know it looking at the DAX this morning or the CAC. Everything down by about 0.3%. Guy, what's under the hood?
So we are up on volume on a down day, which is significant. Pay attention to that, because earlier this week you saw an update in the States on low volume, which again is an indicator, but that's not what we're seeing here in Europe today. 175 up, 407 down. The balance is definitely to the downside today, and there's some heavyweights on the downside as well. In terms of that Swiss story that Lizzie just referenced, let me give you another angle on what we're seeing here, and that is some of the 52-week lows. Alcon, Sika, the Kuehne+Nagel, I just had to do a quick translation there. We should probably fix that. Down by 1.22%. But Sika is in the chemical space. It's down by 1.1%. Alcon in the eyewear space down by 1.2%. Alcon keeps falling. It's on that list quite often. But it's interesting you've got 3 Swiss stocks that are under pressure. Anna, what are we watching?
Yeah, let's get an update on some of the other stories we're following this morning. European car sales rose in August, with new car registrations rising by 4.7%. That's as consumer appetite for electric and hybrid models drives up demand. But sales in the UK and Italy dwindled, and it's not good news for Tesla, seeing sales drop by 22%. Meanwhile, BYD continues to outshine, more than tripling its deliveries. HSBC says it's achieved a world-first breakthrough in deploying quantum computing in financial markets. The London-based bank used IBM's quantum processor to attain a 34% improvement in predicting bond trade prices. The lender has described this as a, quote, Sputnik moment, with banking rivals expected to follow suit. And Oracle sold $18 billion of US investment-grade bonds on Wednesday, the market's second-largest deal this year. Bloomberg has learned that demand for the bond sale peaked at nearly $88 billion. The borrowing frenzy brings to light the current funding gap of AI investment pledges, a question we ask often on this programme, Guy. But right now, we're asking what the SNB is up to.
Nothing. Absolutely nothing. Nothing to see here. Let's move on. I joke. Let's just delve into the details of what we're learning here. The SNB has left rates unchanged at 0. The estimate was for 0. This is exciting stuff so far, I appreciate. But when you dig into the details, actually, they see inflation ticking slightly higher. They see the inflation forecast, though, within the range of price stability. Inflation is likely to be, quote, slightly higher in the short term. Inflationary pressure, basically, though, unchanged versus the prior quarter. 26 GDP growth, likely around 1%, 25, 1 to 1.5. So maybe actually, in some ways, a slight slowing predicted there. But inflation looks like it is going to remain within the range that the SNB is broadly comfortable with. I define that quite loosely. It looks like, and this is actually the most exciting line I can see out of all of this, the Swiss economic outlook has deteriorated due to US tariffs. So there's high tariffs that we talked about a few weeks ago are starting to have an effect. Unemployment, therefore, is likely to continue rising. We heard that a little bit earlier on from Jay Safra-Saracen, the view coming from there. There is going to be an effect, but the S&B, no effect. Yeah, 39% the tariffs on Swiss product in many areas going to the United States. Now, let's get back to the IPEM conference, which is underway in Paris. Kriti Gupta is there for us. A lot of focus on funding, private markets funding infrastructure, private markets funding AI. Where does the conversation go next, Kriti?
Well, Anna, you used all the magic words there because those are the buzzwords at this conference, specifically AI. And this is a conversation that we have in the public markets all the time. The private markets still catching up on how you really use and look at those valuations, and especially how you apply what you're seeing in the States right here in Europe. We've got the perfect guest for that. I'm pleased to say I'm joined by Brookfield's head of Europe, Sikander Rashid, joining us, overseeing about $210 billion for this region. He's here with me in Paris. Lovely to have you. Thank you for joining us here in Paris. I feel like you are the AI guy, and so we're going to get to that in a moment, but you're also wear the hat of head of Europe. So let's start there. We're sitting here in Paris. We're talking about Europe having this moment of attracting capital from around the world. Why, and does it stay?
Yeah, look, Kriti, I would say the U.S. market is very robust at the moment, and the European market is constructive. And the reason I say that is the U.S. consumer is strong. The U.S. GDP is 2 times higher than that of Europe. U.S. has got a business-friendly administration, and all of that bodes really well for M&A activity. And we've seen $1 trillion of M&A deals get done in the U.S. in this year alone. Europe, on the other hand, the story is slightly different. One, the consumer is relatively weak. GDP growth is hovering around 1%. Despite that, we're seeing deal activity. So we've sold our port assets in the UK in a $2 billion transaction. Brookfield also sold right here in Paris $4 billion of stabilized data center assets. And looking ahead, we remain bullish on Europe because interest rates are lower. GDP is now heading finally in the right direction. And Europe as a continent still needs trillions of dollars of capital to upgrade the existing infrastructure and to build new infrastructure for AI, and that is very exciting.
Viewers of our program, The Opening Trade, will know that I often cite the valuations in the public markets, my 2 favorite companies, NVIDIA and Rheinmetall, as they get kind of this AI hype. And it was shocking to me when I used our handy-dandy Bloomberg terminal. I saw that the Rheinmetall valuation is juicier
than that of NVIDIA. And NVIDIA is already trading at such multiples. It begs this question of valuations in the public markets. In the private markets, are valuations frothy? Are they juicy? How are you thinking about it?
Yeah, look, I would say at Brookfield, we are, whilst technology firms are building the brain, we are building the body for AI. And what that means is we are building the power plants, we're building the transmission lines, the distribution lines, and the data center assets, or the kit that goes inside of that data center. And I would say the valuations on that front, so long as we are investing in the right locations, we are investing with the right counterparties and signing long-term contracts, I think we're still earning very strong risk-adjusted returns.
All right, let's go into your specialty here. You mentioned AI there. The AI build-out in Europe feels to be that it centers around the energy security question specifically. How true is that? Are we still at the infrastructure build-out stage, or are we at the adoption stage when it comes to AI?
Yeah, look, I would say it's a bit of both. And energy, in fact, is the bottleneck. So people always talk about, is energy the bottleneck? Is capital the bottleneck? Is adoption the bottleneck? I would say today it is energy, and it's not generation. Generation will never be the bottleneck. It's the transmission and the distribution, or the energy grid. But there's two solutions to that. Previously, electricity was brought to the computing centers. Now, the computing centers, because of this grid problem, are being taken to the electricity generation sites. So that's the first solution. We'll see more build out here in France because there's enormous amounts of nuclear power here. We'll see higher levels of build out in the Nordics where we have lots of clean power. That's the first solution. The second solution is on-site generation through fuel cells or small modular reactors within the next few years.
So you talk, and you've said this in previous iterations as well, that France, because of that energy source, is really the leader when it comes to that AI build-out. But what about the other parts of Europe? When we talk about the UK, when we talk about Germany and their fiscal spend promises, how does the AI playbook apply in the rest of Europe?
Yeah, look, I would say, Kriti, Europe for AI is a very exciting place. And the reason for that is Europe is probably 4 to 5 years behind the US. So as a continent for infrastructure build-out, it is an ideal location. Now, having said that, your question is, what is the right market in Europe to invest in AI? I would say it's either markets that have a big infrastructure gap, and I would say those are the UK, Germany, as you mentioned, and France. These are big economies that will require large-scale build-out in the next few years, or it's markets where there's abundant clean power, and I would say that's Nordics today.
All right, I'm going to ask you a left field question. You oversee a lot in Europe and a lot in AI. What keeps you up at night? What are you worried about?
Look, what I'm worried about is we have a big business. We have $210 billion in assets in Europe. On the AI side, we have $155 billion in total assets around the world. And we have an amazing platform today. We've been investing across the entire AI value chain for the last several years, if not decades, particularly on the power side. What keeps me up at night is we have a great business. The future is bright. We're excited about it. We need to continue to work with the best customers and continue to build in the best markets. And as long as we do that, I think it'll be a really good outcome for us.
Well, I'm glad you brought that up because there is a fear, and we see this in the public markets, we see it in the private markets as well, that so much of the momentum that is fueling the interest in Europe right now is driven and incentivized by public spend and fiscal spend getting pumped into the economy. Have you, when the clients you're speaking to and the partnerships that you're making, especially with some of the AI players out of the States, like Microsoft, among others, for example, is there a fear, are you hearing in the ether, any concern around the fact that the full fiscal promise won't actually come to fruition?
Yeah, look, we haven't heard that, particularly from our clients. But what I would say, Kriti, is we are in a moment where it's a great opportunity for private investors. And the reason I say that is, I'll go back to my earlier comments. First, Europe needs a lot of capital in the next few years, trillions of dollars of capital to upgrade infrastructure and build new infrastructure at a time when debt to GDP ratios in Europe are at all-time highs. So in France, 2 weeks ago, we hit 114%. In the UK, I believe we're just over 100%. And that backdrop bodes really well for private investors. And what the governments, I believe, will have to continue to focus on is the right frameworks for public-private partnerships where governments and private capital together solve that fiscal issue for the government whilst facilitating funding for the build-out of large-scale infrastructure. And I would also say that our announcement here in France from a few months ago with President Macron to build out $20 billion of AI infrastructure in France is a perfect example. Sovereign governments have realized data security and data sovereignty is critical in the short term. It's a great way, construction projects are a great way to stimulate the local economy. Medium term, AI can solve the productivity issue for Europe. And the governments want it to happen, but their balance sheets are stretched, and they want to work with operators like us who can build and fund. And that's a perfect example of what a future triple P arrangement between governments and private investors can look like.
You led me right to my final question. We're sitting here in Paris. You talk about this very bullish investment landscape for AI, but specifically for France as well, and the partnership you laid out. There is a concern, though, as the French government deals with some of these fiscal concerns. Does that mean doing some disincentivizing some business-friendly policies, things like a wealth tax, things like fundraising measures that could weigh on international money entering the system, but also domestic money looking to make those big investments? Are you seeing that dampen some of the optimism around France?
Not at the moment. Look, we have over $30 billion of assets right here in France. Our businesses continue to perform extremely well. And what you just outlined, this has been the story on and off for the last 10 to 15 years in some of the European economies, but we remain bullish on Europe because, as I said, the economies are heading in the right direction. There is a little bit of a geopolitical tariff overhang, but rates are lower. There's pent-up demand for infrastructure, and I think that bodes really, really well for investment in the next 2 to 5 years.
Lovely to see you. Thank you for your time.
Thanks for having me.
Of course, always. Sikandar Rashid there, the head of Europe over at Brookfield. Like I said, overseeing about $210 billion in AUM for this region alone. Guy, I might have found one of the few lone bulls on France in the backdrop of some of this geopolitical volatility. But of course, Brookfield, a major large-scale player, and that seems to be the roadmap here at IPEM, the fact that the large-scale players are the ones driving the investments when it comes to Europe.
And you've got some great conversations coming up throughout the rest of the day, focusing on that very subject. Bloomberg's Kriti Gupta joining us from IPEM in Paris. What are we going to focus on next? We'll take you from private equity and AI to the car sales story. Car sales in Europe actually continue to pick up. Electrics, hybrids are selling. We're going to figure out what it tells us about A, the consumer picture, and B, the global story on cars is a fascinating one and worth paying attention to. We'll do all of that next with Ollie Crook. This is Bloomberg.
Welcome back to the opening trade, 47 minutes into Thursday's session. And European equity markets in the red, off earlier lows. Some of these markets now just down a couple of a tenth of a percent. The AEX actually in the green. US futures are flat. To the upside, we've got retail and autos and basic resources. We've talked about all of those sectors a lot this morning, all of those going higher. And in fact, we're kind of 50-50, sectors going up and sectors going down right now. Now, financial services and banks, certainly an area of focus with some news out of Switzerland. The Swiss financial regulator says that UBS has made progress in its plans for crisis situations, including any potential wind down of the bank. But more work is still needed. Bloomberg Intelligence senior European banks analyst Philip Richards joins us now with more. Help us understand more about this FINMA UBS story then, Philip. So which are the areas that the regulator says UBS needs to try harder on? This is around how you'd wind down the business in an emergency.
Yeah, good morning, Anna. Yeah, as you say, this is not anything to do with be concerned on UBS. It's very much the case, if they did get to this point of non-viability, as it's called, then could they be resolved in a manner which makes it very safe for the country overall? They don't need to have taxpayers' money, etc. And the areas they're looking at is what they call legislative or legal changes which are needed. So not in a way directly under UBS's control. This is, it might be how AT1 bonds or anything else are resolved in that situation.
And Philip, just talk us through the significance of all this. Why is it taking UBS so long to please FINMA here? Is it all on UBS to sort it out? Because I note that FINMA talks about legislative changes that might be needed as well.
Yeah, well, it's very interesting. The reason it's so important is because the size of UBS, a very large bank in Switzerland, a very small country. So in the event of something did happen to UBS, the impact on the country would be massive. And that's why this is such a key topic for them. So the whole issue is that if they did default, what would happen, and could they wind it down in a very calm way? We all know what happened in 2007, 2008, when huge taxpayer support was needed. So that's what's going on. And yes, UBS are going through. They talk about progress since next year, but clearly they're not at that final hurdle yet. And this all comes on the sideline, as we know. The Swiss regulators are asking UBS to have up to 26 billion of extra new capital. So if they went and said everything was fine today, you would say, well, wait a sec, do they really need that extra capital?
It's really interesting and kind of impacting so many other aspects of Swiss life as well. Philip, thank you very much indeed. Philip Richards, Bloomberg Intelligence, Senior European Banks Analyst, on what we've heard from FINMA, the regulator in Switzerland, about what would happen in the case of a crisis at UBS. Let's turn our attention to another sector of the European equity story that we're watching carefully this morning, the car sector. European car sales edged up again in August. New cars registrations rose in the region 4.7% last month from a year earlier. Let's talk more about this and what we're seeing within the data, because this is where it gets really interesting. Our Europe correspondent, Ollie Crook, joins us now. There's a few winners here and there's a few losers. Why are they significant, Ollie?
Yeah, that's right, Guy. I mean, you look under the hood here and you look at the actual brands. I mean, there's so much interesting data to go through here. I'll limit myself to a few things. But if you look at the actual car companies themselves and what they did in the month of August, BYD has got to be, the standout here, up 216% in their August sales from a year ago. SAIC, the other Chinese automaker that is the owner of MG, up 45%. Looking for BMW, who's also one of the big winners here in Europe, up 11%. And Stellantis, we know the troubles that they've been having, really coming in below the trend, up only 2%. And Tesla, you just got to see that number there on the screen. August from a year ago, down 23%, continuing to get hammered here in Europe. When you look at the market share of each of these things, trying to put them into context in terms of actually how much market share each of these brands is holding, Stellantis is there at about 15%. That is a reduction in about 1.3% from a year ago. SAIC, you look at that, the other EV maker out of China, now has overtaken Tesla, which is now at only 1.5% market share within Europe, and BYD, gaining about 80 basis points, so we say, to 1.1%. So again, for a lot of these car makers, we look at the Chinese automakers, they're coming from a fairly low base, but they are gaining market share, and they are gaining it very rapidly.
Yeah, that movement of the Chinese makers, really interesting, isn't it, Ollie? Especially at a time when Chinese authorities are calling on their manufacturers not to take their price war to the United States, not to take over production to the United States as well. So we watch what that means for Europe. So geographically, what are we seeing then? What kinds of cars are selling?
Yeah, so listen, we'll do the geography, but we'll also do the kinds of cars that are selling, because this is where things get very interesting in terms of the engine types, right? When you look at the month of August, petrol sales, or I should say gas sales of cars, was actually down 16%, despite the fact that the headline was up 15%. Diesel down almost 20%. But again, look at the hybrids, look at the battery electric vehicles. Hybrids up 14%, battery electric vehicles up 30%. We should say that last year in August, there was a massive drop in EV sales because a lot of these sort of incentives expired. So there's a bit of a base effect there. But for me, the number that really stood out is the number of hybrids sold year to date in the European Union was almost 2.5 million cars. Compare that to the number of ICE petrol vehicles. That was only 2 million. So this year, more hybrids sold in the EU than petrol cars did. And that is not the case from last year. That is a real reversal that we've seen in 2025. And again, just going to sort of the national level, looking at the EU number overall, sales up about 5%. Germany still pretty strong, the strongest market within Europe, up about 5%. A couple of ones that really stood out was Poland, up 15%, Spain, up 17%, and we've included the UK, despite the fact that they're not in the EU, down 2% in the month of August.
Very generous of you, Ollie. Ollie Crook walking us through that European car sales data that we've already had out this morning. We've got lots of other data coming out today as well, particularly from the US. At 1:30 p.m. London time, we've got the second quarter US GDP third print. We've also got at the same time US durable goods orders, and we also have at the same time US initial jobless claims numbers. But what I'm really looking forward to is hearing from the Fed's Stephen Miran speaking to Bloomberg TV. And I know someone else who's excited about that. That's Valerie Teitel. She's with us around the desk. desk. Val, I wonder what you'd be asking Miran. We know his views on the neutral rate. We've also been talking a lot about AI. I wonder how that could come into the macro conversation.
Look, I think the key question to Miran is what he makes of this AI boom, and does that pose an issue for his call to lower interest rates. You know, we heard from Scott Bessent yesterday. He was talking to CNBC. He was asked about this, and he essentially said that, look, maybe AI warrants a different interest rate, but the Fed sets the interest rate for the real people, for the main street, and that warrants cutting interest rates. But there is a real risk that kind of narrative really gets disrupted by what we're seeing in AI, this investment boom, and the fact that we could have AI raise the neutral rate without a boom of job creation. Yeah. And that would be a massive pickle for the Fed to disentangle.
So what do you do with it? Because you're being told by the president that you need to cut rates. Like, apparently you're independent. So how do you battle these forces at the moment? And is Miran the kind of... What do we listen to Miran for? Like, what is the message that we need to take away from him? Is it kind of what is happening in the economy, or is it what is the White House take on this narrative?
Well, look, he has spoken to the media before this week and has mentioned things like immigration being a deflationary force. Yeah. I really want to hear his thoughts on that because he's thinking immigration is going to be a deflationary force because of its effect on housing. Yeah. Now, housing is a massive part of core inflation, so I really want to pick apart his brains on why he sees that's the case, because you talk to other Fed members, you talk to other economists who see perhaps immigration that's drawing down the labor force, that's reducing the population growth in the U.S., maybe causing wage inflation, because if you can't hire a migrant because they've left the U.S., you have to hire someone else, maybe at an expense of doing a different, higher-paid job. But that is currently something that's being very debated right now, and it means so much for the trajectory of core inflation.
And we watch what we listen to what he thinks because he's a member of the FOMC, but does he also have that larger stature? So to Guy's point, does he tell us something about the future thinking at the FOMC and some of the other voices that might be coming? And so I wonder, we still get voices around the desk, some saying it's still a conventional Fed, and others saying, no, this is going to be a really creative quote-unquote Fed, doing all kinds of things that we don't expect.
Look, I think that does come down to what happens with Lisa Cook's seat. It's all whether Trump has the majority of the federal governor board in order to somehow mess with the reappointment of the regional Fed members, and that's something we still have yet to have an update on. The Supreme Court is currently
But is he the precursor to the next Fed chair? I guess is the question that everybody's asking.
He could possibly be, right? We know that Bessent is interviewing more candidates this week. He said 11 to CNBC yesterday. So this is very much where the administration wants to go.
OK, Valerie, thank you very much. Bloomberg's Valerie Seidel. Well, we know what we're watching for the rest of the day. Certainly that interview, some GDP data out the United States as well. That is it for the opening trade. European equity markets just on the back foot a little. US futures entirely flat. Lots more ahead. The Pulse is next. This is Bloomberg.